We know the importance of trading psychology, so in this video, we are going to take a look at the 5 things in trading psychology that separates winners from losers. An investor or trader with a mediocre trading system but with the right trading psychology will outperform the investor or trader with an exceptional trading system but who is lacking the correct trading psychology 8 out of 10 times. Half the battle is won if you possess the right trading psychology. So if you're just starting out investing and trading, make sure you check out my channel where I share new investing and trading videos every week. Make sure you're subscribed, smash that subscribe button and click on the bell icon so that you don't miss out any of my investing and trading videos. With that, let's go to my whiteboard and take a look at trading psychology and the 5 things that separates the winners from the losers. Number 5 is looking at the big picture. Investing and trading is a marathon, not a sprint. Our goal is to be profitable and make money at the end. We want to avoid making huge returns in one trade and losing all of it in our other trades. Instead, we want to be consistently making small profits and accumulate these small profits such that at the end, we achieve our goal of making money. I'm not saying that we should not and it's impossible to make huge returns in one single trade. It is possible, but with that comes greater risk. So while you might make huge returns from 1 to 2 trades, you are also able to lose all your money in 1 to 2 trades. This way of trading is not sustainable, especially if you want to generate returns from investing and trading down the road. Furthermore, with a greater potential upside also comes greater potential downside. And this leads me to point number 4. Number 4 is accepting that losing and being wrong are inevitable in investing and trading. Even the best investors and traders experience their fair share of losses. And it is not surprising that some of these investors and traders have a win rate of less than 75%. What this tells us that an investor or trader might have the best investing and trading system out there, but even with that, he or she will experience losses because there's no investing and trading system that has a 100% win rate. Therefore, the faster that we accept that losing and being wrong are inevitable in investing and trading, the better prepared we are when we face these losses. Accepting this fact when the losses eventually come, and they will come, we will be less affected by them. And these losses are less likely to throw us off our investing and trading. Number 4 is accepting that losing and being wrong are inevitable in investing and trading. The next trading psychology that separates winners from losers is to think like a casino. In the previous point, we say that as investors and traders, we need to accept losing as part of investing and trading. And one way to do this is to think like a casino or as the house. Some of us will automatically think of gambling when we think of casino. Yes, that's gambling, but the gamblers are most of the players in the casino. The casino does not gamble because the casino is consistently profitable. And that is why tip number 3 is to think like a casino when you're investing and trading. The reason why a casino is consistently profitable is because it has the edge over the players. This means that in any given game, the probability is skewed in favor of the house or the casino. Does this mean in every game, be it poker, blackjack, or any other game that is offered in a casino, the casino wins at every hand? No. The casino will lose in some hands and win in others. But over the long run, the casino will win and be profitable with 100% certainty. This is because with the edge and probability skewed in its favor, when enough rounds are played, the casino will always win. To help you visualize this point better, think of a two-sided coin. There will be a 50% chance of flipping a heads and 50% chance of flipping a tails in a fair two-sided coin. That said, does this mean that if we flip the coin 10 times, there will be 5 heads and 5 tails? Unlikely, but it is usually either 7 heads, 3 tails, 7 tails, 3 heads, and so on, but rarely 5 heads and 5 tails. But with the same coin, if we flip it 1000 times, the number of heads and tails are very likely to be around 500 for heads and tails. Give and take a few, but the percentages are very close to 50%. Why is this so? Because over a large sample size, the result will always go back to the original probability, which is 50% for heads and 50% for tails. This same reasoning is the reason why with an edge over the players, the casino is always profitable over a large number of rounds played. If we have an edge in the market, we will also be profitable over a large number of trades. This is why we want to think like a casino, and why number 3 also ties into number 4 and 5 about accepting, losing, and thinking about the big picture. With an edge, we aren't worried about the short-term results and losses. We are only thinking about the big picture, where we know that with an edge, we will be profitable. So tip number 3 is think like a casino. Number 2 is to trade consistently. Now that we know that we need to think about the big picture, accept losing as inevitable in trading, and think like a casino, we need to trade consistently. If we have tested our system to have an edge in the market, we need to act on the signals that our system gives us. Even with a trading system, many investors and traders do not consistently act on the signals that their system generates for them. Why? It can be because the news say that the outlook for that particular stock doesn't seem good, or because their friends say that they should take a look at another stock. This will impact the profitability of the trader. Remember that even with an edge, the investor and trader needs to trade over a period of time for the edge to play out. By choosing and ignoring the signals that his or her trading system gives, the investor and trader is not allowing the law of large numbers to play out, and as such, this will affect his or her profitability. Winning traders who have an edge in the market trade consistently to allow their edge to play out over a large number of trades. The last tip and number 1 is that investing and trading shouldn't be your only income. If investing and trading is the only source of your income, then there's huge pressure whenever you are investing and trading. Why do I say that? Because you have bills to pay, your mortgage, your groceries, your transportation, and so on. With these bills to pay every month, you feel the need to generate returns every single month so that you can pay your bills. When you have this kind of pressure, you may take unnecessary risks in your investing and trading. For example, if on the second last day, you're down 5% for the month so far, and you have bills to pay the next day, you'll feel the need to make 10% or more by the next day so that you can pay your bills. You'll take more risks so that you can generate bigger returns just so that you can pay your bills. Furthermore, when you don't have another source of income and are depending solely on your investing and trading income, you'll violate all the other 4 trading psychology pointers that separates winners from losers. With investing and trading as your only income, your goal will be the end of every month and you'll not be able to develop a long-term plan and goal. You also won't be able to accept losing and being wrong in the market because your livelihood will depend on you being right and winning. You will think of the next few trades rather than let your edge play out over a large number of trades, and you will start to think like the gambler in the casino. And finally, you will also not trade consistently. You are likely to break your rules and trading system so as to try to generate even greater returns. Therefore, investing and trading shouldn't be your only income. That is not to say we can't generate income and returns from the market consistently. We are able to, and it is possible, but it should be as an additional source of income rather than the only income. Those are the 5 psychology things that separates the winners from the losers. Have I missed out on any pointers that you think contribute to the winning psychology of traders? Let me know in the comments below. Check out my Investing and Trading for Beginners playlist where I share with you tips and strategies on how to invest and trade the right way. It should appear here on my left, so click on the playlist to watch the videos to your financial success.